May inflation is out this Thursday, June 5th, and early estimates point to the lowest reading in over 5 years. That may open the door for monetary easing, just as global financial landscape faces major shifts. Now, Japan has lost its status as the world's largest creditor, while the United States has been stripped of its last AAA credit rating. Two of the most influential economies in global finance are under pressure, raising questions about capital flows, currency stability, and investor risk sentiment. Now, what do these global shifts combined with softening domestic inflation mean for the Philippines, and how should investors be positioning themselves for the second half of 2025? Joining us now is Cristina Ulang. She's the research head at First Metro Investment Corporation. She's going to be talking about all this and more with us. Hi, Cristina. Good morning, and thank you for being here with us.
Hi, good morning, Mikey. Thanks for having me.
Okay, so Cristina, we'll start with the twin developments. Japan losing its status as the world's top creditor and the U.S. losing its last AAA credit rating. How do you think these developments are going to influence global liquidity, particularly for emerging markets like the Philippines?
The markets now are being governed by geopolitical risk, geopolitical consideration, and so we're seeing this reduced Japanese position in terms of their lending. But if you're going to look at the external assets, their assets is even still growing 11%. It's just that they are now second to Germany, and then China is the third. And I think what is at stake here is global liquidity. And if Japan becomes more inward looking, then there could be some repercussions on global liquidity. But I think they're trying to reorganize their expenditure priorities now, given all of these considerations. Geopolitical, the US saying that defense spending should go up. It should be like 5% of GDP, 3.5% of GDP for some Asian countries. And so I think Japan as an ally is want to be in sync with that, and they're, I think, reorganizing reprioritizing all of their expenditures. And that, I think, that's one factor, but that doesn't mean they won't be investing abroad. We are a big beneficiary of their FDIs, and that should continue given the improvement in our investment environment. But with regard to the US, the US losing its credit standing is negative in terms of the continuing high interest rate environment there. That's on top of inflation rising because of the tariff that were imposed on the rest of the world and China. So it's keeping the long end of the US treasuries elevated. The term premium is rising, and that's going to be a higher cost of borrowing for dollar bonds, for dollar borrowing of emerging market countries like us. And so I think our government borrowing, would lean more towards domestic sources. That would be the impact
So
for
our
us.
borrowing mix is going to change. Christina, stepping back a bit, what kind of signal do these twin downgrades have on investors globally?
I think this is going to be like a reassessment. It's going to prompt a reassessment of in what asset classes should be positioned given all of the geopolitical uncertainties. The uncertainty is very high, so you would want to be in conservative assets that give you consistent yield. And so fixed income would be the number one, but not necessarily in USD denomination. So Philippine fixed income market is one big alternative for investors wanting a safety and a consistent return on a regular basis. And of course, the strength of the Philippine economy, the sovereign credit of the Philippine economy, which is triple B plus, that's one attraction. And of course, our credit rating, which has not been downgraded, very solid at triple B plus, and maybe affirmed and may even be upgraded if we continue to remain resilient. So it's fixed income and equities also, because the BSP is reducing its key rate, and then we'll have more liquidity. Peso is stable. Corporate earnings are growing, in our GDP will be one of the best in Asia, 5.6, 5.8%. That's good for equities.
Of these twin developments, Christina, which one do you think is really on a whole the biggest drag? Which one of the two will be the bigger drag for the Philippines in particular?
I think the reduction of U.S. top tier credit is going to put the fiscal houses of emerging markets in the spotlight. Credit rating agencies are going to look into the fiscal sustainability, debt sustainability issues facing economies. And I think government will have to produce the growth that is needed to bridge our budget deficit, which is about 1.5 trillion estimated for this year. That's why BSP will be doing the heavy lifting in as far as rate cutting to shore up the economy, stimulate the economy, and of course also government will need to spend. But the question is, if your growth is going to slow, where would tax revenue be the same, or will you be reducing your spending because tax revenues are slowing, or would the government be borrowing? But what is fixed is the budget for this year, 6.3 trillion. So they have to spend that, but the tax revenue is the variable thing. And so the question is, will there be more debt supply coming out of the government in order to fund the fiscal support that is supposed to stimulate the economy and enable 6% GDP growth for this year.
Cristina, earlier you mentioned, the borrowing mix is going to have to change, and how everyone around the world just needs to be a little bit more conservative. How do you think that's going to change our borrowing mix in the Philippines? At present, it's at what, 25-70? Where do you see it at present, and how do you see it changing as we get into the second half of the year?
Mm-hmm. Historically, we have been, government has been borrowing on a mix of 75% domestic and then 25% foreign sources. So maybe that could change even with the peso stability, because U.S. term premium are rising. Interest rates in the U.S. are not expected to really come down in a big way, because the central bank, is on a steady mode, very conservative, because the inflation risk is still there because of the Trump's tariffs, and U.S. growth is still in positive territory. It was upgraded to like 0.3% first quarter of this year. And the labor market is still very strong. So the U.S. economy is very strong. What there is no need to cut for the Fed, and even BlackRock is predicting that there zero cut for the Fed this year. And so U.S. Interest rates are going to be elevated, and that's going to be very costly for us in terms of additional borrowing. So I think the government will be concentrating on local sources, which are
Local
more
sources.
stable and peso
So a more
denominated. Maybe
conservative
70-30. Maybe 80
80,
domestic,
okay.
20 foreign.
Okay, so they take a more conservative stance when it comes to domestic borrowing in favor of, doing everything, getting everything they need from the local market. Cristina, on another front, the downgrade in the U.S., them losing their last AAA credit rating, it puts pressure on the Federal Reserve, which, it's a tough spot for them. How do you see that affecting the BSP? Everybody expects rate cuts by the BSP as early as June 19. Do you share this view? And how many more rate cuts for the balance of the year, given that the U.S. is inclined? Some even say that the U.S. should keep rates steady until 2026.
There will be 4 meetings of the Monetary Board. It's going to be this month, and then August, October, and December. The central bank was very clear in communicating that more rate cuts are on the table. It may be 2, it may be more than that. And then there's also talk about more triple R cut happening. And so I think the signal is very dovish, and that there will be more liquidity in the market, more support for the market, so that the economy can grow, and the banks can continue lending and fund the capital expenditure requirements of corporates. And I think the second half is going to be like more support for the economy coming from fiscal also. And that's why the debt supply may rise, and because the budget deficit may have to be adjusted in a bigger way, or maybe the collection of taxes may have to be um, turned more efficient. It has to become more efficient, especially VAT collection, so that they are able to generate the taxes. Because the number one concern really is the growth slowdown. And if you have a growth slowdown, then your budget deficit is at risk. Maybe the fiscal consolidation program may be changed. Maybe the targets may be softened, so that there could be some delay in meeting the targets, so that the government may have some leeway in spending and propping up the economy. I think that's going to be good for growth prospects in the second half. So you'll have a combination of government spending, and then BSP. And that's very good for both the equities market and the fixed income market.
That's
More
right.
opportunities and a lot of opportunities.
That's right. They'll have the latitude to do so because May inflation is expected to, something it's going to even be lower than April's 1.4%. What's your outlook for May inflation? That's out this Thursday. What are your expectations, Christina?
Mm-hmm. Just around that level, 1.5% for the month of May. And that's really going to be driven by food inflation, especially rice, which is in negative territory. So that should help the BSP make a decision on June 19.
Yeah, June 19, rate cut baked into the cake, at least 25 basis points, you think, Christina?
Of course, yeah, that's going to help the entire yield curve move lower, especially the short end of the curve. And the long end of the curve might remain elevated because of market thinking that there could be more debt supply, and then the U.S. credit rating downgrade there lurking in the background. And under the deficit may be revised, and the risk of unmet fiscal targets may be there also a concern. And therefore, the long end of the curve might be higher than originally thought. But that's going to provide rich yields for investors who are into the long end, like the 10 years, the 15
Yeah,
year, the
10, 15,
25
and
year.
20.
I think, yeah, very good opportunity in terms of the yield. But in terms of the trading opportunity, the short end and the belly provides a lot of price upside.
Christina, amidst the shift in geopolitics, the downgrade of Japan and the U.S., and the cabinet reshuffle here, and then we've got, lower GDP, 5.4% in Q1, and we've got inflation expectations to be, pretty benign. What kind of economic environment, how is the economic environment shaping up for the second half?
Mm-hmm. Well, we have just heard Mr. Trump raise the tariff to 50% on steel and aluminum. So I think the second half, in terms of the tariff imposition, there could be some risk of an escalation, a re-escalation, especially now that he has been being barred by this lower court that all of these tariffs are illegal. But the appellate court has actually said that the tariffs will stay. So I think given the personality of the Trump's government, the tendency to really assert its power, I think there could be some escalation again of the tariff jitters in the second half. But the trade deals should come through. I think the trade deals that is being clinched with the rest of the world should come through to ease the jitters coming from this renewed escalation. And so the volatility of markets will remain, and that is where the opportunity lies. The Philippine equities markets very much driven externally, not so much by local fundamentals. And that is number one, the corporate earnings. We've seen corporate earnings just grow 3%, and yet the PISA managed to rise by 12% from April to May. And now we're seeing the peso also faced with a wider current account deficit forecast, but the peso has appreciated 2.5%. So I think the second half is going to be marked by a lot of external influences muting domestic development. But of course, we need to have all of these fundamental strengths sustained, like our low inflation, BSP rate cutting, and government fiscal support for us to really have the GDP target that we need, which is close to 6%.
And one last question, Christina. In this environment, where do the opportunities lie?
Of course, equities, the two catalysts are looming, and that is really the inflation that's going to come out this week. If it beats the 1.4%, then that's going to be cheered by the market. And then second quarter GDP is also due, which we expect to be an acceleration of the 5.4 in the first quarter, and then the rate cutting of the BSP. So there are really three events that's going to be major catalyst for the equities market. And the market is very cheap now. It's 11 times PE, 9, 10, 11 times PE. Corporate earnings may still do a catch-up in the second half. So this is an opportunity to invest in the equities market and to be complemented by fixed income investments also. In the long end, if you are the type who would want steady cash flows and a lock in terms of the yield, very high yield.
All right. Thank you so much, Cristina Ulang, the head of research for First Metro Investment Corporation, for sharing your thoughts with us.
Thank you. Thank you. Bye-bye, Mikey. Thanks.